Hi everyone. Thank you for visiting my channel and my video. My name is Han HAN. I'm from Zen Mortgage Inc. I'm a licensed mortgage broker, owner. I'm also a real estate and note investor myself. So the topic I'd like to discuss with you today is created by investor and for investor. Whether you investor to be or you are more intermediate or seasoned investor. So there is a few products in the market in terms of the mortgage product that you may want to understand a little bit more. And today I'd like to share with you two main topics. The first one is I want to talk about house hacking, which in this market, when the interest rate is still high, the pricing is still resisting in still market, especially in a little bit higher, less affordable markets like South Florida or metropolitan area where it's a lot of job and a lot of economic growth. For that reason, the rent is good. So it's good for investor in long runs for hopefully for some cash flow and future appreciation. And then the second topic beside the house hacking one and what type of loan we can use for you to put the least down payments and acquire your first investment properties is the investor newbie. And then the second topic is the difference between HELOC and HELOC, home equity life credits and home equity loan as a second mortgage. So I'm gonna go discuss more about what's the difference and what is the pro and cons and what scenario that which type of loan would fit you the best when you consider to get some equity out of your home, whether your primary, secondary, or investment property to grow your investment portfolio or real estate portfolio in the future, right? So first of all, this is for a newbie investor, especially if that was like first-time home buyer, but also excited to be a first-time investor as well, and how to get out of the rent life, right? Renting for so many years. Why wouldn't you buy something that you can at least 90-80% living rent-free? And then in the future, hopefully you can increase the rents and then you can make some cash flow and go and scale your portfolio from there. So when we say house hacking, that's mean 2 to 4 units. It's still under the umbrella of residential real estate. And luckily that's in the past before 2023. So in order for someone, a normal consumer, they want to buy their primary home, whether it's first time or not. So they have to put at least 20% down for them to acquire any type of property to 2 to 4 units, not single family, right? Because the idea of that is you're going to live in one unit, you occupy one unit as on occupy, and then you rent the rest. And you, the rent of the rest, make a payment for your mortgage and tax and insurance. So that is the idea, right? So, and after 2023, a good news that now you can only require to put 5% down payment for your duplex, triplex, or quad. Just as you can get the mortgage and then you can scale from there. Like instead you just buy one home, one unit, and you have to make a payment, work 9 to 5, or running your business to make a payment for your one single family or one unit. Now you can buy up to 2 to 4 units, and then you do all the rent to offset your monthly payment. Hopefully 100% or more, but if not, at least 80-90%. Better than you're gonna rent, right? Basically, 5% down payment for 2 to 4 units conventional loan. You can acquire 2 to 4 units from now on. Yes. In order for you to learn more about whether you could qualify or not, what you should do before you talk to me or talk to any other licensed loan officer or originator in my team, you should collect a few key information. That means how much is the purchase price? If you put down payment is 5%, what would be the loan? And the most important thing is is the rent? What is the rent for all of the units? And if you acquire one unit out of 2 or 3 or 4, so what would be the rent for the other units? Because the lender will use 75%, or another word is 25% vacancy rate. So they use 75% of whatever the rents of those non-owner occupied to offset your monthly payment. For example, if your monthly payment for four units is, let's say, 5,000 a month, right? But you can get at least 4,000 and 70% of the rent of the other 3 units. So basically, you only need 1,000, which is the difference between the monthly payment you require to make a payment 5,000 a month, and then 4,000 equivalent to 75% of the other unit you not occupy, but you will rent it out. So this is some strategy that for the first-time home buyer or those first-time investor, they always think that they have to make a lot of active income from their W-2, 1099, or business based on tax to qualify. But the reality is not. You just need a bare minimum, which is normally the difference between the mortgage payment, including tax, insurance, principal, interest, and whatever 70% of the rents of the other non-owner occupied units. So likely that you could qualify if you max 3,000 or 4,000 a month. You could qualify for those, but it's gonna very much depends on the property. To do back to the quote. So, for more information, reach out to us. We will help you to analyze the deal and make it happen for you. And now, the second topic is going to be, what is the difference between HELOC and HELOC? And this is more for those who already own investment property or already own primary, secondary home. So by leveraging, you're going to get more equity out. It had to be a reasonable level, and use that as a down payment, or use that to venture out to grow your portfolio, whether it's in real estate or the other businesses, right? So the key difference is you have to ask yourself that what type of investment you're going to use the money from the equity of the home that you have to invest, and how quickly you can have some cash flow to pay it back. Is it short term or it's going to be long term for years? And is there any other type of income you have, right? So that's the question you need to ask yourself first. But likely, most of the time, it's going to be a long-term investment if you're planning to use the equity to grow your portfolio. But some cases, you want to get the money out, and then you're going to do some new construction or new renovations of existing home, or you build ADU, which is very popular right now. So it's going to be a little bit different, right? And you have to think about what source of income you're going to make the payment for the loan and how fast you're going to pay it back. So if you think that it's just short term, in a year you would have a different source of income, or even you would have a very good net rental or cash flow from the new investment to pay it back. So you should consider HELOC, which is the home equity line of credit. It runs like a credit card. So the typical one is you can do, I want to introduce a few terminology, is a draw period. That means it's like a credit card. Basically, when you use it, let's say you have $100,000 for your HELOC, right? So the lender will give you the option, maybe you choose 5-year draw period. 5 years. That means the first 5 years, you use it, you pay it back. You use it, you pay it back, right? When you use it, you pay it back, you create a room again. Let's say the day 1, you draw 100%, 100K. But day 2, you're going to pay 50K back, right? And when you pay 50K back, that means your unused limits right now from 0 to 50K, right? And then the day 3, you're going to withdraw another 30K. So your loan amount is 80K, and then you have 20K left. It's exactly like a credit card with the limit and the utilization. And that's what happened for the first 5 years. You can do many times you want. And the interest, we call it simple interest. It's going to calculate based on the actual balance daily, right? It's different from a normal mortgage or a second mortgage, a second loan that we're going to talk later is amortization. But HELOC is a simple. Interest occur based on the actual balance on daily basis. So in some cases, if your cash flow very active, so HELOC would be the option for you, because whenever you have the money coming, you can pay down it, so the balance will go down, and then when you need, you withdraw it. When you don't need or you have money coming, it's go down, so that it will save you the interest more if that fits into your business cash flow situation. And normally it's going to be short term. And if you want to get is 100K to be your ADU, right? And then the ADU bring you, in the future, you can do Airbnb. It's bring you 4,000 or 5,000 a month. Whatever you have income, you can route the income into that account. So the balance will go down. And hopefully in the first few years, you're going to pay it down. This is save more for you if understand that how it's work. And the other option is the HELOC. HELOC home equity loan is the second mortgage. And the second mortgage it's like a normal mortgage, right? It's like normally you can have often 15-year, 20-year, 25-year. And even in some cases, some lender, we have you a little bit longer. So it's just like a normal amortization. That means your monthly payment will include a small part of principal and then interest for the life of the loan. So your monthly payment includes 2 parts, interest and principal. And the interest will be bigger than the principal. And normally after the first half, the second half is going to be reversed. Every monthly payment is more principal and less interest. So we call it amortization. Whether you have to draw it and you use it or not is up to you. But the day that you draw it, you're going to have to pay a fixed monthly payment, principal and interest. No matter the money come in, but you don't use it to pay off or pay down the loan, you have to pay a fixed monthly payment for entire life of the second mortgage home equity loan. And that will fit into the model of, okay, I will use it as a down payment for another property. And that would be long term. So, and I think another reason is we're going to consider in terms of the interest rate. Normally, the HELOC, the interest rate will be lower than HELOC because HELOC is considered shorter term. So, and is most of the time is variable rates. It's going to base on the RAM rate and then the spread, which is the profit that you have to pay for the lender. It's ranging about 2% up to 3-4% on the top of the RAM rate. That's based on whatever in Google, you can search federal RAM rate. And then for the HELOC, second mortgage, normally a fixed rate, is lower than the HELOC because it's going to be fixed for 15 year up to 25 year. So you will see right now, I would say it's around 8 to 9 to 10% for HELOC, and then 1 or 2% higher for HELOC. But remember, depends on how frequent and your usage, which one gonna be more cost effective for you. Okay, so that's it for today, and I hope you enjoy the content I just shared with you. If you have more questions, follow-up questions, feel free to reach out. And I'm here. Thank you. Have a wonderful day.